Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the second episode of our InvesTips from the CIO's Desk series. I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer and the host for this series. Today I want to talk about the first step on the road to financial freedom, managing debt. Typically, when you borrow money, there are two things that need to happen. First, you pay interest on that debt, so typically monthly, which is a regular expense that you need to pay. Second, ultimately you'll have to repay the debt. Now, not all debt is equal and not all debt is bad. So at one end of the spectrum, a mortgage is generally low cost and is used to buy an asset that, over the long term at least, is likely to appreciate in value. Therefore, debt in the form of a mortgage can actually be beneficial from a financial perspective, as long as you can meet the regular repayments. Now, as an aside, a key lesson for every investor is you never want to be a forced seller of a property or a part of your portfolio due to the inability to service debt. Therefore, it's important to take into account different potential scenarios when it comes to projecting your ability to service that debt. So for a mortgage, obviously, the outlook for interest rates is particularly important, especially if you're borrowing on a floating rate or short-term interest rate basis. On the other hand, credit card debt is particularly dangerous. Now, credit card debt carries an extremely high interest rate, which can compound very, very quickly if you're not careful. This is the biggest risk to you attaining financial freedom. Think about this as a ship with a gaping hole below the waterline. You cannot bail water out quickly enough, and eventually you go down with the ship. Now, if this is how you feel, this episode and the next will give you tips on how to fix the hole in the ship as quickly as possible and then stabilize the ship. The risks here are so high that I think it's important to spell out how a credit card works. It's surprising how many credit card holders don't understand this until they're already in trouble. So the best measure of a cost of a credit card is the annual percentage rate, or APR. This is effectively the rate of interest the credit card issuer will charge on any outstanding balance. Often, this rate is between 25 and 30%. Therefore, if you owe $1,000 on a credit card and you don't do anything, the amount owed becomes between $1,250 and $1,300 after a year. Now, if that doesn't scare you, just think about what happens if you roll it for 5 years. It becomes between $3,000 and $3,700. And this is why people can get into trouble very quickly. Now, one mistake often made is to pay what's called the minimum amount of the credit card, which is typically around 3% of the outstanding balance. But at the interest rate charge, you can see that even if you assume no new spending on the card, this barely reduces the outstanding balance, and the money flowing out of your account to service this debt gives you no benefit whatsoever. Therefore, the first step to financial freedom is to stop this cycle and pay off your credit cards as soon as possible. We'll talk in next chapter about about the need for sustainable spending habits, i.e. a balance between wants and needs. However, if this is the situation you find yourself in with spiraling debts, the key is to do everything in your power to reduce this debt to zero as quickly as possible. Now, examples of things you can do to accelerate this process. So there's some obvious things, right? So firstly, stop spending on your credit card, so get rid of them. Secondly, cut all unnecessary expenses. Third, temporarily move back in with your parents, hopefully obviously rent-free to save that cost and then redirect the money that you would have spent on rent to paying off credit cards. Get a second job to increase your income, or sell things that you own to pay off your credit card debt. Now, these may seem drastic, but you're sinking and you need to fix the hole as quickly as possible. I'm not suggesting this will be fun at all. However, if you pull all the levers at your disposal that we discussed, you'll be amazed at how quickly the situation can be stabilized. In the next episode, we'll discuss a framework about how to think about and prioritize spending in a way that is sustainable for you. I look forward to seeing you then.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.